Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for the week ending in Sunday, November 3rd, 2024. I titled this, Will Rising Yields Lead to More Than a Minor Correction? Last week I asked if we've seen the top for the year. There's a lot of countercurrents, and hopefully by the time I finish this, you'll get a sense of what I'm thinking, and hopefully it'll give you some insight into how you might want to manage your portfolios. Again, my name is Jeffrey Scott. My email address is hgsidoc@gmail.com. If you're new to my YouTube channel, hit the subscribe button, hit the alarm, and you'll get notified when I post these. I have been doing this for, over 20 years. I do these for my friends, and really I do this for myself because it forces me to follow a systematic review of the market and analysis of stocks, and I found that to be very important in my trading success. If you like what I'm doing, there's a website I'll mention called stocksanddocs.com, and I post similar videos on a daily basis when I'm not traveling. And for those that follow me, I've just got back from my cruise, 36 hours travel time between airports and flights from Singapore home, but I'm back, and I'm back ready to start hitting the markets in what's going to be an interesting week. As always, this is for educational purposes only. Any recommendations are in the spirit of education and should never be considered investment advice. The intent of the video is to demonstrate the tools of top-down analysis and how I apply them. Trading involves risk, and you are solely responsible for any investment decisions you make. I may own or intend to sell any stock mentioned in this report, and trading stocks and options should be considered risky, and you should always consult with your financial advisor before making trades. I have tools in multiple platforms, but I am an independent trader, meaning I don't own any of the platforms. Now, people ask me which platform do I like best for doing my analysis, and I might say there's probably no perfect platform, so I'm probably always going to be using more than one. But the reality is there's a lot of great platforms. You'll see me using wealth charts a lot in this presentation because I think Rob Hoffman, who's a brilliant trader, super guy, has done a great job in creating an all-inclusive platform and was nice enough to build my tools inside. And I offer a marketplace add-on. I've got tools in TradeStation, TradingView, and Praveen, who genius programmer that did my TradingView indicators, has actually created an app that will mimic in one tool most of what I do in this presentation. And I'll show you some of the pictures from that as well. I trade the same regardless of which tool I'm using. So you'll find in the PowerPoint that I'm going to use several of the different tools. But when I go through in this presentation, I'm going to go through wealth charts to look at the markets. Here is the website that I mentioned, stocksanddocs.com, and that's where I do my daily analysis. They're usually 5 to 8 minutes. Reality is if I travel, I don't do them. I usually announce the day before that I'll be traveling. I'm back. I should be doing them pretty religiously over the next couple of weeks until Thanksgiving. I always start with looking at the major markets, and I think it's important that you got to look at more than one day. So I look at 5 days, I look at one day, and then over to the right, beginning of the year, and then off the 52-week low. Now, it's important that you notice here that all these 52-week lows say 11-1. That's not the date the market bottomed, but we've now lapped the bottom of the market. And you could see across the major indexes, we've had major moves since that bottom, even the lapped bottom. So we're missing the beginning of the move. And since the beginning of the year, we've also seen a big move. So we have been in, and technically I think we still are in a bull market. The question is, are we in the midst of a modest or mild correction, or do we need to be much more worried? If you look over here, you could see the only index that finished in the green for the week was the Russell, and the Russell was up 0.6 on Friday, and on the week was flat. I think it was 0.01 if you take it out a few more decimal points. The Dow was down 0.2 on the week. The S&P 500, I highlighted the equal weight by here. The equal weight was down 1, and the spiders were down 1.4. The NYSE was down 1%. Both the NASDAQ Composite and the Qs were down 1.5 to 1.6. And the Mag 7s, which were mixed because you had some up, some down, were off almost 2% on the week. ARC Innovation, which had been doing well of late, was down 2.2. Now, Bitcoin led on the week. The NASDAQ seems to be turning around on the NASDAQ Biotech. Let me be more clear about which part of the NASDAQ. We'll see if that's making a move. And if you look back over beginning of the year, the NASDAQ Biotech has certainly been a laggard. If you look at sectors on the week, the only positive was communications. Financials were flat. Discretionary was next. And some of the interest rate sensitive, like real estate, utilities, led to the downside. I think the interest rates are a real problem here, no pun intended. And we'll talk more about that as we go forward. This is the Q Edge tool. Now, this is powered by Metastock, and I will also have my tools in Metastock shortly. They've been programmed by Jeff Gibby and his team. We're still working on them. And again, there are lots of good packages or platforms out there. I have all the ones that I've mentioned, and I want to be able to do the same analysis regardless of what platform I'm in. So here, what Sagar with SuperiorProfit.co has got a couple of spreadsheet tools as well as add-ons for TradeStation and Metastock. And it's a great way of looking at the market. You'll see Praveen in my app is actually built upon it. I introduced him to buckets that I learned from Ian Woodward and how I use the buckets to tell me what the market is doing. And this tells me here that on Friday close, 62% of the stocks were below the midline in the S&P 1500 of their Bollinger Bands. Why the S&P 1500? It's got the 500 large cap, the 400 mid cap, and 600 small cap. So this tells me we're in a downtrend here. Most of the stocks, or at least we're in an area where most of the stocks are below the middle of their Bollinger Band, which you see in a downtrend. All right, and it's improved some over the last day. If we look at the Friday close, we can see that 64% of the sectors were up, 58% of the industries were up, and 54% of the stocks were up. I think that's very useful information. I made a comment early in the session to Praveen that the market's not nearly as strong as the indexes are acting. Why? Because we saw a lot of red in those pie charts, even though we were up 200 points plus on the NASDAQ and high 300s on the Dow, maybe 400s at one point. And it really gave me real-time information. It said, the strength, the breadth isn't holding up. Maybe this market's going to come down. And certainly the indexes did come down over the day after a big move up at the beginning after the weak employment numbers, which were probably biased by hurricanes, Boeing strikes, etc. Down here, we have a reproduction of the sectors, industry groups, and stocks, and looking at 1-day performance, 2-day performance, which is decidedly negative, 5 days, which is closer to neutral, but over the last 2 weeks, it's been a pretty negative, and over the last month, it's been a negative market. So this market, which had been super strong, and where we did see recent highs on the S&P 500 and the Dow Jones, has not been everywhere. And clearly the Russell has not set new highs since 2021, and the NASDAQ has not set a recent new high. This is it's called the total breadth view, and Sagar has been able to capture a lot of the breadth indicators that Ian Woodward popularized that I use, among others. This here combines the NYSE and the NASDAQ. It's driven by Metastock data. And what I wanted to point out in this combined view of the NYSE and the NASDAQ, he's had Hindenburg's the last 2 sessions. You don't usually see Hindenburg Omens at market lows. You see Hindenburg Omens at market tops. And a Hindenburg Omen only counts if you have a second one within 31 trading sessions. And I believe we confirmed back here in August. We had another one in September, and we just had 2 more. Now, I'll be the first to admit the August ones didn't play out. But seeing these makes me a little nervous. Now, What do we mean by didn't play out? Well, we didn't have a big correction. Well, historically, 1 out of 4 Hindenburg Omens has a big correction. Traditionally, it's only the NYSE. And the others don't usually see the market go up, but you don't get a big correction, sometimes just sideways moves. So will this turn out to be something worse? I think the Hindenburgs have to go in the column of market concerns. If we look here, you can see the NASDAQ had one on Wednesday, and we saw both on Thursday and Friday in the NYSE. Now, the NYSE is probably more concerning. That's the traditional one. I've made the case and did a video on it not too long ago of some analysis of the NASDAQ as well. So the Hindenburg Omens are interesting. Stocks above the 50 have come down hard on the NYSE. Stocks above the 200 have come down hard on the NYSE. They've also come down on the NASDAQ, but perhaps not as hard. So breadth is clearly weakening. We have the Hindenburg Omens, reasons to be concerned. And if you look at the major indexes here, you could see similar patterns of stocks above the 50, stocks above the 200 have come down. Now I want to introduce you to this light green line here. That's a 3-month high low. And you could see across the different indexes, we've gone from overbought to not quite oversold. We bounced off of oversold on the Dow, 30 stocks will move quickly. So we're not to a point where we see reversals. I typically, when I get down to these double line area, I start talking about almost a certainty, guaranteed reversal in the next few bars. But we're not there yet. So we have weakening breadth, but not to the point of concern. Here's my weekly timing model. Now this is taken from the app. It looks very similar in wealth charts, except I've been able to program at the bottom of each of these ETFs, green if it says to be long, red if it says to be short. So even with the weakness in the market that we saw on Friday or this past week, it's a weekly chart, we are still above the WMA in all of the 4, and we're still in a buy mode. So put that in the positive. And you might say, well, Jeff, I mean, how can you ignore what's happened? Well, here is the spider, for example. It went into a buy mode on November 6th. Not at the very low bottom, but it's captured and stayed in a buy mode all the way up. So you've had these pullbacks to the WMA. You've had a breakdown of the WMA, but there are defined rules. And when you see it built into an indicator, it's following the rules. And the rules have said stay long. So am I ready to short the market, go into my long-term positions and get out because I don't want to deal with another 2007-8 disaster? Not yet. Do I want to go all in? No, because look at the daily. The daily is now flipped to a sell on each of those. So how does this bother me? So it tells me at minimum we're in a correction mode. It could be early of a massive pullback. So when I see this, I'm not adding to my long positions. When the dailies have gone to sell mode, it tells me to take profits, raise cash, tighten stops, and start to think about protection. Protection to me means, do I buy some contra ETFs, especially with the news events coming this week? And except for the seasonality that we have, and which we'll talk about in a few minutes, it's something you have to think about. Here's from my app, and I really love this because it's real-time updated, and I'm able to look at the major ETF, index ETFs and the volatility. I can look at any given point. This is the close percentage move on the session. The range was how big of a percentage move did it make during the day. And the closing range, for example, the VIX was down. But it was at 90% of the closing range. So it was down a lot more and almost made itself back. That's not good if you're long the market when the strength, even though the VIX was down, was in volatility. And you could see the spider, which had a big move at the open, was only up in the 9th percentile of its closing range. All of these closed in the bottom half of their closing range. In a strong market, not only do I expect to see high volume, but I expect it to see in the upper part of its closing range. Over here, net new high, new lows in all these time frames, the NYSE and NASDAQ are negative. That's not a sign of strength. What worked on Friday, you could see discretionary, technology, and healthcare. What didn't work, utilities, real estate, and energy. Utilities and real estate, interest rate sensitive. I've got themes here, and you can see that biotech was number 2 behind cannabis on Friday, and even over 5 days, biotech did well. I think it was probably the leading group or one of the leading groups over those 5 days. Telemedicine, digital health, here's semiconductors, telecommunications. Again, this is updated real time, so it gives me a sense in the market of what's working. Now, I showed you how Sager has done a great job on the S&P 1500, looking at sectors, industries, stocks, advances, decliners, and stocks above midline. We've been able to expand that looking at the NYSE and the NASDAQ. And if you look above the midline, 45% on the NASDAQ, 35% in the NYSE, and 37% in the S&P 1500 above the midline. And this looks a little different than, actually, is it 37? Yeah, it actually doesn't look different than Sagar's. It shows a market that's weak overall. And one, add that to my concerns. Next, are rising rates a signal setting a signal in the setting of more rate cuts? We're expecting the Fed to cut Tuesday another 25 basis points. Tuesday or Wednesday, I should know that. And you could see markets don't like rates that go straight up, and finally it's impacting on the markets. The 10-year on the left, 30-year on the right, 3% increase on the 10-year, 1% increase on the week on the 30-year. Why are they going up? Well, there's a lot of debt that's got to be refinanced, and in the setting of the current world economy, people are having to give more interest to buy some of this longer-term instruments. What determines mortgage rates? That 10-year is probably a big factor, which means rates haven't come down. I think this is a worrisome chart. And the short-term rates are improving, which is why the yield curve improved, the inversion improved. But I think this is sending us a signal to be concerned. And rising rates might be good for banks, regionals, and insurers, but falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. So these rising rates means your REITs are under pressure, MLPs, your utilities, your dividend payers, and your home builders. Do we have a recession in the near future? I apologize for people who don't like seeing this every week, but I like it because it forces me to look. Every time the yield curve crosses back above normal after the inversion, which we've had for a while, you get a recession. If you go back here to the 80s, you get a recession. Those recessions occur a while after the normalization of the curve. So I don't think we're out of the woods on a recession. I just don't think we have one until next year, perhaps right after the inauguration. If you look at the 10-3, this is about to correct as well. If you looked at tightness of money supply, money getting expensive, we don't see that here. In fact, this is a Bank of America high yield index option adjusted spread. It spikes during times of economic uncertainty, of recessions. Don't see that. And if you look here at Philadelphia Diffusion Index for economic activity, and it's updated last 2 weeks ago, it's positive, which you don't expect to see in a recession. So nothing imminent on a recession. As I mentioned before, breadth weakened, stocks above the 200 drop, stocks above the 40. And this is the 3-month new high, new low, where I started using it in Warden. This looks at pretty much the whole market. And if you look at the indexes and you look at what typically happens when you bottom, is the indexes bottom. And when you hit the top, it's usually when we've hit a short-term peak and the indexes either go flat, sideways until you work off some of that exuberance, or they come down. That's why I watch this. I've been watching this for so long, and I've built it into the other platforms. I pointed out a couple weeks ago, maybe last week, that I thought it was weird that the NASDAQ was going up when we're seeing big drop-off in the advanced decline line. And, I think right now everything's aligned. Stocks are coming down, and so is the AD lines. Here's the buckets again, and you could see at least on the close Friday, that we're at 12% of stocks are below the Bollinger Bands in the S&P 1500. That is not a signal of doom. That when it gets to 25, 35, 40 is when we're so bad the market's likely to reverse. Not as many above the the Bollinger Bands, no surprise. When that gets to 25, 30% or higher, it gives you a signal to look out for a reversal. So no signals here. Now, Praveen was able to duplicate this, and what we have is the ability of breaking out and looking at the NYSE, the NASDAQ, the Russell 1000 for large caps, and the S&P 1500. The skinny gray was yesterday, was one day ago. The bar is the most recent close, so you could see improvement here in the last day. And the wider gray is a week ago. So over the past week, you've seen a bigger move to stocks to be in the lower part of their Bollinger Bands and a higher percentages to get below. So we might be getting close to a signal on the NYSE. It's almost above 18%, and we'll watch that. Now, what was interesting on Friday is you look at the S&P 1500, you actually had more stocks, not more absolutely, but you actually increased the percentage of stocks above the bands on both the S&P 1500 and the Russell 1000 at the same time as we still are building up the number of stocks that are below the midline and, with high numbers below the lower band. So that was interesting to see. Heed the Hindi. The Hindi is fired now on both the NASDAQ and the NYSE Common. That's enough to make me concerned. If you go and look at, for example, HGSI, which, to me, that's where this all started. That's still one of my favorite tools. And you look at any chart in HGSI, you could build a view of the Hindenburg, and you could see in HGSI we had 2 days in a row here. And this to me is my standard that I like to use as the rule. All these other programs, everything interprets it a little bit different, but you could see we fired on both the NYSE and the NASDAQ this week. The new lows are creeping up on both, but they're nowhere impressive. When we get to 15% new lows, 52-week new lows, I start to get nervous. Or maybe I should get excited because when we get to that point, we're probably getting oversold. This is the breadth tool that we built in the new app, and you could see stocks above the 17, stocks above the 50, stocks above the 200 have all turned over, worse on the NYSE than on the NASDAQ. You could look advanced decliners, new high, new lows, high, low volume. You could see they're all turning down here, less bad on the NASDAQ, which I think led on Friday. And this is a triangle that occurred on the NYSE on Thursday. That's the Hindenburg Omen. So we've captured a lot of that in the app as well. Now, another way of looking at the market is to look at performance of stocks. And let's look at by ERG. ERG is EPS rank plus relative strength rank plus group rank. And in a strong market for growth, you have a curve where growth is really outperforming. Well, you got to throw out the head because there's no stocks, and the tail, there's no stocks. So if you really look from about here to here, do you really see a pattern? No, it looks like broad-based chop. If you look down here, your worst performance was a low EPS rank and your best was high EPS rank. I like to see that because I'm an earnings guy. But interestingly, the best performance was in low relative strength versus higher relative strength. And stocks that the prior week were accumulating actually had the worst performance, while prior week distribution, although down, was the least down. So this is more rotation in a choppy week, and that's all I could say. Not a great week. Now, seasonality. One of the things that I really like about wealth charts is all the stuff that's included. So I just looked at the major market ETFs, and no, you don't see the diamonds and you're missing others, but I asked which ones have strong seasonality for a swing trader time frame, 10 years of data, strong seasonality over the next 4 weeks. And these are the ones that came to the top. Well, the dollar I don't like seeing there, but it's not very big performance. But according to wealth charts, the Russell, the Qs, and the spiders all have over 4% projected change to the upside in the next 4 weeks. That's pretty bullish. In fact, if you look at the Russell and you look between October 30th, which was the most recent date behind me, and you push that a month forward to say November 27th, you're up 10 years out of 10 years with an average return of 4.42%. So not only is the Russell strong for 4 weeks, it might still be strong going out beyond that. And you could see the annual performance, even in tough market years, you could see the Russell has been positive during this period of time. And you could also see that the Russell followed the projections down and is now in a strong up move. So I get nervous massively shorting the market when we have this seasonality. Well, this is the indexes. What about the NASDAQ 100? Look at AMD here. Same 4-week period, October 30th to November 27th, up 8 out of 10 years with an average return of 12.84%. This is showing over the next 4 weeks, 16.5. This is probably 5 weeks that I have here marked off. SMCI, forget that they've got scandals going on with their accounting. But NVIDIA up 10% over the next 4 weeks. Now, just because seasonality has worked in the past doesn't mean it's going to work this year. But it's hard to argue with something that seems to happen year in and year out. So I would put the strong seasonality in the category that says, yeah, you might be negative on some of the market here, but be careful because you have, diverting opinions. Seasonality says it's going higher. Know your news and earnings, and I think, here's the important things. And actually, I was wrong. It's not Wednesday. It's actually Thursday. I guess they probably pushed it back because of the election. And this way, they don't have the rate increase until after the election. Tuesday, election day. We'll get some ISM services, but really, who's going to win? I think the market will be happier if it's a split decision and that nobody takes the House, the Senate, and the presidency. And I think that's probably the most likely. And I'm not going to make a call because that's not what I do on whether it's Harris or Trump. But it is interesting. There are different sectors and industry groups that will probably benefit by who wins. Jobless claims on Thursday, but it's that Fed rate decision that'll come in later on. And then sentiment on Friday. So is it the biggest news week? No. But how can it be bigger than having a president election and a Fed decision? So it's a pretty important week. Lots of earnings. I'll just leave it at that. Judgment call to hold stocks over earnings dates. Bad judgment to not know when your stock's earnings date is scheduled. So thoughts, huge week in terms of earnings, economic news. Major indices closed mostly lower. Mega caps had mixed responses. News this week, election results, Fed meeting, earnings, employment, other economic data. Last week I asked if we've seen the top of the year. This week will likely inform as to whether we're going to have a shallow correction or something more ominous. We have Hindi's, deteriorating breadth, strong dollar, rising rates are all things that might be concerning. Now, the weekly timing model is still long, allows me to position myself to the long side. However, with each of the index ETFs turning to sell on the daily, I have trim longs, raise cash, and likely add some downside protection going into the election. If you like this, again, it's much shorter, stocksanddocs.com. Now, for those that have never been here, this is halftime. Although I'm not going to be pushing a lot of stocks today, so probably 3/4 time. Because at this point, I'm going to drop into wealth charts and take a look at various programs or various charts, stocks, indexes, etc. I do at least one live meeting every year. I always do something in June in Orange County, and I'm planning on doing something in mid-December in Palm Beach, so that'd be 2025, and correspond with the launch of the app and the other tools that we talked about. So let's look at the market. So I'm starting with the week we had. Here's the close on the prior Friday. And then you could see we gapped up on Monday, didn't do much during the session. Gap down at the open Tuesday, but basically closed back up a little bit on the session. Wednesday, gap down, recovered. Then Thursday, we sort of, going into Thursday, we started selling off. Big tech earnings coming. Big gap down on Thursday. And Friday, even though we had a big gap up, all we did is go back to where we gapped down on Thursday, and we couldn't even hold that. So this is a negative looking chart. Negative looking chart closing near the bottom of the week. So if you look at the daily spiders, you could see we have broken, let me take off that as an old high line, that we were hoping to stay above this line of consolidation. We are freshly in it. Now the key thing is we're looking at that yellow bar, or yellow line, which is the 50-day, and interestingly, it pulled right back into that 50-day moving average. So I think this is something to watch. Hopefully what was at some point resistance back here becomes support. And I also think there's an important line going back here, which was prior resistance. Prior resistance turned to support. We certainly don't want to break that line. So the first line in the sand here in the S&P is the 50, and the next one to look at is that line in the sand going back to the tops back here. Weekly spiders, just to show you, that doesn't look strong, does it? That was down 1.4%. Looks to me like we're rolling over on the weekly charts. Interestingly, just to look at the monthly chart, you could see for the first month going back to the reversal here in November. Remember, my buy model said go buy November 6th. With this reversal here monthly, this was, we had a down month here, quickly reversed. Maybe we'll get that same thing here. But we had another down month for whatever it's worth. If we look at the daily on the Qs, this was MACD divergence signal, and it fired. Same as the prior story. We've got the 50 here and then this line of support underneath. I think this market could easily test and fail at both of those. If we look at the diamonds got back above their 50 on Friday, but they have pulled back as well. And if I look at the Russell, which has not made new highs since November of 2021, also has pulled into the 50. I think we're at really important places on several of these indices. If we want to look at some volatility, how did it do in the week? Look at the weekly VIX. And interestingly, it didn't do much. An inside week, 4.87. Now, we had an up bar the prior week, and my guess is this resolves higher. We had lots of inside bars when I looked at indexes and the charts. If we look at the dollar, this to me has been a challenge for the market. You see the dollar was up on Friday another 0.41% on the week. Again, another positive move up on the week, 0.14% as well. If we go and we look at commodities, with the dollar rising, gold has come back some. A lot of people, including Goldman, are calling for gold to get up to 3,000. I wouldn't put that past it, but right now gold has gave you a bit of an island reversal here and has come back. On Friday it was down 0.5%. Silver similarly coming back 0.91. Oil is an interesting place. You probably got more supply coming on as OPEC has signaled that they're easing some of their restraints. You still have embargoes on Russia, but that doesn't seem to stop China and India from buying. And if China and India are buying Russian oil, that means they're not buying Middle East and other oil, so that will help supply. Then you got Iraq getting ready for its response to Israel's attacks, so that should cause oil to go higher. So mixed currents, oil is treading water, broke down below the 50 on Friday, down 1.45. Natural gas is just a picture of technical analysis. It fails at the 200 and is still, as I would say, dead to me. And then the other thing that concerns me, we talked about before, the 10-year up here, you could see was up 2.27 on Friday. If we look at the hourly charts to see anything that was showing outside strength as we ended the week, a couple things jump at me right away. And one of them is communications. So let's just give it a star. Shapes, objects, star. And why do I do that? Because this way I can come back and look at what it did the rest of the week and see if how it held up. And the other one is discretionary. Same thing, let's go to shapes, objects, let's steal a star, and let's put it on the top over here. So those are my leaders right now, looking at it on the ratio charts of the sector versus spiders. What's worrisome? Well, maybe not worrisome, but if this market was rolling over, why would staples, real estate, and utilities be weak? Now, healthcare also has been weak, but maybe it's trying to rally, and you can see biotech perhaps leading that. But the strength, pretty clear to me, it's communications and it's discretionary. Now I like going into my scanners. I am not in go buy, 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 buy mode, so I'm not going to be pushing a lot of stocks today. I just tell you that right now. If we start by going to the heat map and looking at the S&P 500, it was mixed. Now let's look at the big guys. Let's start with Apple. Apple came out slowing revenue growth rate. I don't think their earnings were necessarily bad. You could see beat by 2.5%. But the problem with Apple, I think, is people are looking at slower growth. So technically we broke through this line, wherever you want to put it here. I put it lower here, but I think it's probably more appropriate there. I think that Apple right now, until it gets above this line, I probably wouldn't touch it. NVIDIA broke above its line, pulled back some, had an inside bar up 2% on Friday, but typically inside bars, they continue to go down. But something happened at the end of the session in the after hours on Friday. And what happened was, see if this will show. That's not going to show. What happened after hours, mess with this. I should learn not to mess with things. What happened after hours is you could see NVIDIA, which during the session was up 1.99% and closed at 134.70. After hours got up to 139.09 in a 3.5% move. It got added to the Dow Jones. So I guess there's probably some ETFs and funds that might have to buy NVIDIA. Is that going to propel it to new highs? We'll see. Kind of looked like we were rolling over here, and an inside bar doesn't change that. Amazon, this one had the stellar earnings. You could see a 25% beat on earnings. Really like this, but it has a tendency after big earnings beats historically to pull back, so I might wait for it to give me it at a lower price. Now it has broken out of that triangle. Tesla, pulling back from a double top area, but when you go further out, you can see Tesla is still way off of its prior highs. I wouldn't be a buyer just yet. Meta, recent highs, pulling back. And again, when I say I wouldn't be a buyer, I'm talking about my own personal behavior, and I'm also talking about education and why I wouldn't. I've got Meta sort of double topping here, pulling back, still above the 50, still looks healthy. I'm not sure it's telling me to do anything with it right now. Microsoft screwed the pooch on earnings, didn't do much on Friday, so it squirted through the bottom of this line. Have to get, probably I would like to see it take out, if not that trend line, at least get back above the 200 before I got interested. AMD, which has great seasonality, is pulling back to long-term support. You know, if you bought it back here when it got hammered, you did okay. If you bought it back here, you did okay. If you bought it back here, you did okay. With strong seasonality on AMD, I might be looking to see if it touches and bounces off that long-term trend. Google also had decent earnings, but gave it back some of their big gap up Thursday and Friday. Who else have I missed? Lilly, not a FANG stock, kind of disappointing earnings. This is a company that's just been doing so well. and had a pretty big beat, an 18.6% beat. Um, people who know me personally know that I've been a big fan, and I use Mangiano to lose about 60 pounds, and I'm taking it still, and it used to be I couldn't get it, which could be they're selling too much or they can't make enough. I think they're making enough now, so perhaps some of their earnings miss might be tied to Mangiano's supply, but technically the stock has had just a massive run. It was getting expensive is kind of all that I would say. But is it a buying opportunity off the 200? It certainly was a buying opportunity after this fall. But, you know, show me some positive momentum. Intel. Intel had good earnings. Don't look very good there, but I think when you back out and you look at some of the things they talk about going forward, it wasn't, they were considered very positive. They had to move up, but falling knife. I'm not sure I'd be buying Intel here. Boeing popped because maybe this time their offer will be accepted by their striking people, union workers, but really like Intel, sort of a falling knife here. I think this one probably has a better short-term chance of reversing. And then Netflix will massive uptrend continues, probably giving you an opportunity to get back in. And don't know why I'm losing all my stuff down here, so I know how to fix that. So let me pause. You had a great day here with earnings on Netflix. You could see the 5.4% beat, and now it's flagging. So, what I like to do is I like trend lines. So I'd probably be drawing something and saying I won't touch it. Just see something here. I'm probably using the wrong trend line. No, it doesn't have one that says extended. I'd have to break above that line before I'd be interested in buying Netflix here, and you could probably draw one off the bottom. So a wedge. Excuse me. And then I think the last one I wanted to look at is what you hope you don't own. Talk about falling knives. You never want to be fired by your auditor. Now, SMCI, which was one of the big market leaders here on the left, certainly an AI leader. I've mentioned several times that they weren't a creator of new technology. They were assembler of supercomputers and a major customer of NVIDIA. Now we're going to learn out, are they cooking their books? And fraud's a big problem, which they haven't mentioned that word yet. But having your auditors fire you when you are a source of revenue to the auditors probably says somebody's not happy. Now they're supposed to come out on the 5th, I believe, which will be Tuesday, and give us their update, and we'll see if they can talk the stock back up. But that is a problem. Can you imagine this is weeks after a 10-for-1 split? It'll be interesting to see. It'll be interesting to see what happens, and do they get a relief rally? Have to see what they say. But it's a dangerous place. If we look at Wealth Scanner, get a sense of what's working in the market. So it's looking at a list of sectors. It's going to rank them. And the first thing I see, and this is problem, there's nothing above 800. So we got nothing that's really strong. Oh, no shocker. No shocker whatsoever. Communications here, robotics, cloud, internet. Some of these things would fall under the discretionary, software, short bonds. Now we get into the 600s. Worrisome. If we look at bearish, pharma, real estate, energy, international real estate, developing world, dividend players, agricultural, bonds. Not a surprise on most of those. So just looking at this, do you see a super strong market? I don't either. And that's why I think that, again, seasonality aside, there's a lot of negative things going on. I think with the presidential election, a lot of risk there. I expect 25 basis point cut. I think anything besides that might be viewed badly by the market. Obviously, be interested to hear what Powell says about some of the recent data. So if we go into the CAT scanner, and for whatever reason it's not reading my combo list, which is there, let's just look at all equities. So I've got this set to look for pullbacks and uptrends. So I'm looking for stocks. I'm looking for this. I'm looking for stocks in an uptrend that pull back and then they move up with momentum. So let's look at what they find. Abbott. Here's your uptrend, pullback, breakout. Um, high-low says 52%. That's not a problem. Good relative strength, good OBV. I'm not a big fan of this name, but there's nothing wrong with that chart. Earnings were back here, so this is not pure earnings. I'm going to look at some that I looked at over the weekend. Beautiful chart here. ACM, big uptrend, pullback, and a breakout on Friday. I do like that. Coming out of a squeeze, breakout in momentum, relative strength, and OBV. Temper, when I say I like things, to recognize, A, this is education, B, I don't like the market here. But if the market was to turn around. ALB, a lithium producer, kind of below the 200. I don't like that. Volume breakout, momentums, relative strength, and OBV. That part looks interesting, way off the highs, but I don't like the below the 200s. Let me rank it by dots here. Amazon we already looked at. Great move on earnings. You'll see down here a lot of dots came in if it ever lights up. Volume breakout, momentum, out of a squeeze, great relative strength and OBV, not too extended. I just anticipate when I see something that looks like this, that it's going to do a little bit of this before it breaks out and goes higher. So I would rather buy it when it breaks out of that. Doesn't mean it can't just keep going higher on its own. Cardinal, one of the companies I've worked for and sold a company to, which has probably been the laggard of the Cencora and McKesson Cardinal Group, had great earnings, 16% beat, big gap up, volume, breakout, momentum, not extended, relative strength, and OBV. I guess when I see a move like that, I still want to make sure that it doesn't give me a pullback for a while. Charter, I said communications were strong. This is one that seems to be very economically sensitive. Pull back here after a big uptrend above the 200. Here's the launch indicator from from Rob Hoffman rather, and a wealth signal. It already had an EMS buy here, which came in earlier. Had earnings that showed a little beat, 2.3%, but massive volume, breakout momentum, out of a squeeze, great relative strength and OBV, not extended. I like that one. I'm just going down the list. Marvell Technologies. This one's been doing pretty well for a tech stock. Here's your pullback to your 17, and there's your volume breakout momentum, good relative strength and OBV, not extended. TileInterface.com, big move after earnings. And that's kind of the theme here, is the stocks that had the big move on Friday, a lot of them had earnings Thursday night, a 41% beat. That's one that I would pay attention to, but again, it's now extended, and will it drift lower before the next move higher? AMSC is actually in the solar space, I believe. And here's your pullback, your uptrend, and a big move here on volume, 2 sessions in a row, coming out of the squeeze, good RS, OBV, not extended. I like that one as well. So HOLX, I like that chart pattern. Now I like to see it, and maybe has it now broken out? Let's take a look. Drawing tools, lines, trend line. Move that out of the way. Start up here and bring it down. So you could start to say that maybe it's breaking out. Now it didn't close above it, but I'm going to look to see if it takes out that trend line on a close. Great volume, breakout momentum, out of a squeeze, relative strength and OBV look good, not extended. IDCC, I've been watching this since this pullback here, had a beautiful breakout, and guess what on? Earnings on Friday with a massive beat. It's extended here. Maybe look for a pullback, but this is one that I put on my buy watch list as well. So there are a lot of things that are working, but did you notice I said earnings, earnings, earnings on almost every one of them? Now let's just go to my buy watch list. These were about 50 stocks from looking at a lot of stock charts that came to things that I thought were interesting looking. And let me just show you a couple of the ones that I liked. ADMA does look like that, but with much smaller prices. So what did I do wrong here? It should be working. Let's see. Not updating. So let me hold on a second. Well, I have an issue with my wealth charts updating my charts. So I'm going to move over here and just look at a couple things using TradingView. I've got the same basic indicators in here. Some of the charts that I like, this is AbbVie, move up, pull back, and then a big move here. This I think was on Thursday, and you can look up here. You can see their next earnings are out, so they must have just had earnings. So 2% beat on earnings, 4% beat on revenue. We've looked at a lot of these already. Halozyme is one that I like a lot. Here is a stock, healthcare stock, big uptrend, pull back, and I wish it would take out this line before I get too excited. But this one had earnings on Friday, or on Thursday, and you could see a 32% beat on earnings, 15% beat on revenue. A break above this line, I'd be long on Halozyme. Again, educationally, I'd be long. I may already own it for all you know, and you could see down here it had a gap, volume, breakout, momentum. This is the daily relative strength versus the spider. This is the weekly, both turning positive, the OBV turning positive. I like this one a lot. Other things, Insulet, PODD. I love the pattern, pullback. Here's your support line and a breakout off of that support. Shocker alert. Let's see, that was not earnings. Thought that one was earnings too. So I like that. Anything else? McKesson had a huge move, and I don't usually get that excited after a 25% move. But McKesson is in the same group as, let me flip this to a weekly chart. It's in the same group as Cardinal. And you could see how McKesson did. And this was in 23 when the markets were not doing great. And it sold off as the markets have improved. McKesson has been a great company, is a great company. And they had a huge move on Friday. Earnings are due the 6th of November, so I'd be careful about that. And I think, this move may have been in sympathy with Cardinal, which had a great move. On pace for largest percent increase. Gets ready. I'm a big fan of McKesson. I've competed against them in many of the companies that I've started, sold, and then worked for the acquirer. But McKesson is one that's on my list, although I'd probably be careful going into earnings. A couple of things that have pulled back hard that I'll be looking for a move. This is Oscar. This is I guess it's a Medicaid provider. It's come well off of its highs. If I put a 200-day moving average on the chart, you'd see it's come right back to the 200-day moving average. And then another one, and this is what I call bottom fishing. Here's a stock that just really is a great company, Guardant Health, and it's starting to move off of a bottom. Notice it had volume breakout momentum. Two of my buy systems are positive right here. Earnings are coming out next week, so Again, a reason to be careful. It's a great company. It's just its stock, let's look at the weekly here, has been hammered, as you could see. But I think it's an interesting time in the market. So let's just summarize my thoughts. A lot of things to be afraid of. We've got the daily model in a sell. We have Hindenburg Omens. We have Breadth that's doing worse. We still got what's going on in the Middle East. We have the volatility related to an unknown presidential election. And I think we've had at best mixed economic data that to me doesn't show that we have no inflation. In fact, I'm wondering if inflation's actually getting better. And let's counter that by we've got a 25 basis point cut. We're in the best part of the year to be long stocks. And I think it's an interesting decision. I'm not going to make any major decisions in my mind until we get through this presidential election, and hopefully it will go peacefully without too much mudslinging and complaints that the election was rigged. Because once it's done, we'll know whether we've got three chambers, President, Senate, and House, that are divided, which means the market will be happy, or if they're all together in the same side, that might be more concerning. And once we pick which person is going to be our president, we'll have a better sense of perhaps what industries or sectors. I think inflation is going to be a problem. And I think part of the reason rates might be going up is in Trump's case, you've got tariffs galore, which are likely going to be inflationary to the consumer. And in Harris's side, you have spend, spend, spend. Could be inflationary. If you look at historic market versus GDP, we're also kind of at historic highs. So I think there's a mixed bag at best. I think it's a time when I feel comfortable raising some cash, and I'm going to play around in my mind about whether or not I put in some protection before the before the elections. I remember in Trump version 1, where everybody told us, everybody being the press, that if Trump wins, the market's going to go down huge. And the funny thing is, or ironic thing, maybe more than funny, is I went to sleep. I was in New York, even though where I was at the Westin across from Pfizer on 42nd Street. And I went to sleep thinking I'm going to have to work a few more years because my portfolio was down big time on election night. And I woke up the next morning and I'd recover most of my losses. And then by the next day open, I was positive. So even though after hours, the futures, and you could look at the after hours trading of a lot of your positions were really bad, it quickly recovered. So I have a hard time believing that anybody knows anything of what's going to happen. So to me, I'm waiting and seeing. I hope you have a great week. I hope I didn't ramble too much. I did look at a lot of stocks, probably more than I intended. I think the theme here is simple. If you have earnings and you beat, you go up. Everything else I'd be worried about. Have a great week. We'll talk to you, Stocks and Docs, on Tuesday morning.